I can't think of a better time to actually have this conversation the day before one of the most consequential Fed decisions in recent memory. And of course, you and me are going to have a conversation tomorrow afterwards as well on CNBC Live. But let me just begin with the question that everybody wants to know. What's going to happen tomorrow, 25 or 50?
It's interesting that nobody thinks it's going to be zero. You know, it started out in December. People thought the world had lost its mind because if you looked at the pricing out of the bond market, the treasury market, it was predicting 7 rate cuts in 2024. And by late January, everyone thought that that was just crazy. You know, we all collectively lost our mind to be pricing the Fed that way. And it got down to a couple of months ago, it was just like, well, maybe there'll be 1 in 2024. And the real outlier, you know, perma doves for the Fed said it was going to be 2. And now the way things have changed so radically. I mean, it was incredible. Last time we did the show on the Fed meeting, it was July 31st. And I listened to Jay Powell in the press conference, and I was struck by how dovish he was. He was talking about how they have a lot of room to cut. And it occurred to me, well, of course he's right. I mean, the Fed funds rate was at 5 3/8, and the inflation rate, there's a lot of different inflation rates out there. You can pick whatever one you want, but there's a lot of them that are around 3. So you have a real Fed funds rate that's the highest it's been in a long, long time. And it occurred to me while I was just watching that press conference, I thought, you know, I think they're going to cut like 150 soon. And I kind of blurted that out. I don't know if you recall that, Scott. I said, I think they're going to cut 150 within a year at the most. And you actually were so astonished by that, you actually said, wow, which you can't script the wows, you know, that has to be real. So I think
there's some made-for-TV wows, and then there are real wows. Yeah, that was a real wow.
So now we're pricing in 9 cuts. I haven't looked at it today, but I'm sure it's not much different. 9 cuts in the next 12 months. So much more dovish, much more aggressive rate cutting than we had at what we thought was the nutty season back in December. I really do think that the Fed's going to cut 50 tomorrow. I think they're going to cut 50. They seem so out of line. If you look at, I'm sort of famous and I get criticized even though I'm right about this. The Fed just follows the 2-year Treasury. And the 2-year Treasury is down at 3.6. And so the Fed needs to cut rates 150 pretty quickly. And I think they're going to start with 50 tomorrow.
Is there any reason why they shouldn't do 50, given how restrictive they are relative to the inflation rate?
I think they should do 50. You might recall that your first question back July 31st was, do you think the Fed should have cut today? And I said, yes, they should have cut today because now they're behind the curve. You know, what's really interesting is since July 31st, the 2-year Treasury yield is down by over 60 basis points. Over 60. So if they were behind the curve on July 31st, if they cut 50 tomorrow, they're further behind the curve after tomorrow than they were July 31st.
Right, they're still too restrictive no matter what they do tomorrow.
They're not going to cut 75, although I'm starting to hear the lunatic fringe talk about 75 tomorrow. I think you need further economic weakness to get to that type of sort of, it almost sounds like an emergency cut at 75. But 50 is completely plausible and should be what happens tomorrow. And you know, the inflation rate has been coming down, and I used to use the copper-gold ratio as my beginning point for where the 10-year Treasury yield should be, and it worked really, really well for decades. But what has happened with economics and with interest rates and markets is even people like me who have been around forever, I've been at this for over 40 years, we think we know how things react and interrelate with each other. But I came to the idea, basically the first time we were here 2 years ago, that interest rates are not falling anymore. And everything that has informed our ideas over the last 40 years was during secularly declining interest rates. And that's not happening anymore. I mean, they're falling in the short term here because of the Pavlovian response to weaker economic data. But I don't think certain relationships are going to hold. So I've come to the conclusion that falling interest rates was due to disinflation or stable low inflation. And that now we have rising interest rates. And so maybe people aren't buying gold just as a place to go when there's economic weakness. Maybe they're buying it because they don't trust the collapse of the institutions that we're observing. And I think everyone knows what I mean by the collapse of institutions. I can elaborate. It would take me all day to go through the full list. But people don't have faith in the Constitution, the Congress, the FBI, the CIA, the Supreme Court, the electoral system. This all needs to be replaced. And I think why people are buying gold, putting up to 2,600, I mean, it's up almost 30% year to date. They're buying gold not because of economic reasons, like fears of the economy. They're buying it because they don't trust the system. And so I've kind of rejected the copper-gold ratio. So I'm looking at now that has the best predictive patterns is just WTI, crude oil. And crude oil is below 70. And it was up at 80. And every time you get a $10 move in oil, you can count on half a point coming out of the CPI. So with that decline in oil, I think the CPI, our model says the CPI is going to, by February, if oil stays where it is, which is a big caveat, that the CPI will have a 1 handle for several months in a row. And if that's the case, there is no way you can justify a Fed funds rate that's even 4.
Well, how many cuts do you think we'll get this calendar year? And if you want to better answer it with the total amount of basis points that they cut instead, that's fine. But what do you think transpires the rest of this year?
I think we get 50 tomorrow, and I think we're going to get another 50 by year end and a 25 in the middle. So that would be 125. So it'll actually be 5 cuts between today and the December meeting, inclusive.
Do you want to also comment on, as they're doing this, it's pretty unique, wouldn't you say, that they're cutting not because the economy is so weak, as would be traditionally the case when the Fed starts cutting interest rates. They would be cutting into a really weak economy. Here, it's not the case.
Well,
they're cutting because they're too restrictive.
The economy is weakening. It hasn't gotten to that negative sign in front of GDP, and it doesn't look like that's going to happen this quarter either. But it is weakening. I mean, Jay Powell spent a lot of time at his press conference in July talking about the reestablishment of balance between labor supply and demand. And what he's looking at is, the jobs available and people looking for jobs, and they're back to the level, one versus the other, is where they were pre-pandemic, except for one small thing. If you take out your magnifying glass, it's actually less demand for jobs. There's more supply than there was pre-pandemic. It's just by a little. But the trend is what interests me, because Jay is applauding the fact that supply of labor and demand for labor is back in pre-pandemic balance. But if you actually look at the trend, it's been moving into balance month after month after month, but the trend is very powerful. Just like the trend in the unemployment rate is undeniably weak at this point. The U3 unemployment rate is definitively above its 36-month moving average, which has never failed to trigger a recession, ever. So that looks like it's pretty likely to suggest recession. And all the other labor statistics are in that same mode, where they're on the edge of where you are typically at the front edge of a recession. And so one thing that has gotten a little bit of play, but should get more play, is it seems odd, and I'm going to be cynical. This is a highly charged political season. And I'm going to be cynical and note that every first Friday of the month when we get the employment data, it's touted to be really good. And then the months subsequently, it gets revised lower. And it got play, but not enough, that there were 818,000 jobs that were reported to have been created in the past 12 months that have been wiped off the blackboard, that didn't really exist. And if you look at the household survey, this year there is negative job growth on the household survey, which tends to be the stronger of the two surveys, household and establishment, leading into economic weakness. So I think there's I said on July 31st, I made the maybe extreme statement that the history books would say that the United States was in recession September of 2024, and I still believe that's true. I think we're in a recession right now.
You said that on your most recent webcast, I think on
Yes,
10th
as well.
of September
Yeah,
as well.
I did.
So why do you think that?
It's just the accumulation of the data. Leading indicators have been terrible for 2 years. The average work week is shrinking in a very convincing way. And first they cut the hours worked. First they cut the hours, then they cut the bodies. And I don't know. I see an awful lot of layoff announcements on the daily news wires. So that's kind of why I think we're in recession, is it seems that there's a lot of layoffs happening. I see a lot of, this company, this big company is laying off 5%, 10% of its workforce. That sounds recessionary to me.
But when you hear people come on various, media outlets, ours obviously included, CEOs who are on the front lines, boots on the ground, they're talking to consumers, they're, talking to all sorts of businesses in a wide range of industries, say soft landing's possible. You don't believe that one is? It's not like it's impossible, it's difficult. In '95, the Fed pulled it off. Why can't they pull it off this time?
I think they've just stayed too tight for too long. And the consumer has been using credit cards very, very heavily. Credit card debt is at an all-time record high. The average credit card rate, I saw it yesterday, I couldn't believe it. I thought the average credit card rate had a 23 handle. This thing that I saw yesterday said it's 28. I mean, that's an incredibly high rate. And there's a growing awareness that we have, and I've been talking about this for so long, people are tired of me talking about it, but we're now in crunch time. It's not a future problem, it's here and now, that we are borrowing massive amounts of money and the interest expense has caught up with us. We have $1.2, $1.3 trillion of interest expense. Why are we say we're in a growing economy and we have a budget deficit that's nearly 5% of GDP. What's that about? Why do you have to borrow 5% of GDP at the federal level if you have a good economy? Well, get this. We're really borrowing about $2 trillion. They say it's less, but they don't count all the wars and the natural disaster relief and stuff. They pretend that it's a one-off, even though we're always at war. And we're really borrowing about $2 trillion per year. And the interest on the debt is $1.2 trillion and rising quickly, which suggests that we are actually borrowing money to pay our interest. Think about that. We're like a deadbeat consumer who is maxed out on a credit card and making the minimum payment by borrowing money on another credit card. That's what we're doing. We don't have any money. So when I hear stuff like we're going to do a super fund, we're going to propose a super fund in the United States to do good things, with what? With what? We don't have any money. And so I think we're in this moment where the potential of problems has just, the waves of the potential of problems are crashing on the shore. And I think you're going to see a very substantial decline in economic growth over the next 6 months. And I think we're already in recession.
What does it say, though, about the Fed chair and the Fed itself that here we are? I mean, if I ever told you last year or 18 months ago, Jeffrey, we're going to come back together at Future Proof 18 months from now, and the economy is going to be doing reasonably well, and the Fed is not going to have cut interest rates at all, and the stock market was going to be at a record high, would you have told me you're crazy for thinking that?
Probably. But I think what we've all sort of learned is it's similar to that thing about secular interest rates, that now we're in a different environment and we don't understand where we are in that. That's also true of the macroeconomy, because we dumped $7 trillion into the economy. And that money is still sort of around. A lot of it's been spent. M2 has not been growing for the past couple of years, but a lot of things are well above the trend lines of the decades prior to the pandemic. So you had M2 money supply growing in a linear fashion, and then suddenly it went vertical. And now it's sideways, but still, if you took the trend from pre-pandemic and plotted it forward, we're still well above that trend line. That's also true of the level of CPI. This is what the politicians don't understand. The electorate is unhappy, not because the inflation rate year over year is crushingly high. It's that prices are so high because the CPI, and this is not a coincidence, has the same look as the M2 money supply, rising like this. It was actually rising pre-pandemic at about 2% per annum, exactly the Fed's target for 20 years on average. Both core and headline, almost exactly the same. And then all of a sudden, here comes the $7 million dump truck of money, and the CPI goes like this. And it's still rising, kind of like M2, but CPI is rising a little bit more than M2 is. But it's still rising. But price, it's not rising very quickly, but price levels are really, really high. Another thing that's very out of line, too, in the same manner, is the median home price relative to median disposable income is off the charts in terms of unaffordability. It's like it was, you ready for this, in 2005, 2006. So we have the price of houses has gone up so much, and they continue to rise, and yet disposable income, while rising, is nowhere close to as much. So we have all of these dislocations that were caused by that money printing. They're still kind of lingering around with us, and I think that explains why everybody was far too early to predict that the traditional rollover in the economy was going to happen. But you know, what can't go on won't go on.
Do you think the Fed's done a good job? What grade do you give Jay Powell today? For aside from the mistakes at the beginning, which were admitted by them.
I give him like different semesters, grades for different semesters. I said before, when the Fed first started to raise interest rates, you'll remember I said, paint or get off the ladder. Like, what are you doing here? You should be raising 100 basis points today. They were so far behind the curve on raising rates. It was so obvious that there was excessive money growth, and it was clear that the inflation rate was not just going to go to 2.5. It went to 9.1 for a brief moment. Well, I say now, paint or get off the ladder. They're behind the curve. So they got an F in 2001, 2002. Then I would give them sort of a B plus A minus for what they did in 2023 and early 2024. And now I give them an F again because they should have cut rates in September. And now there are people talking about 225 basis points of rate cuts being needed as a base case. Well, I don't think that you can wait a long time if you need that type of relaxation of credit conditions. I don't think you can wait months and months and months to do it. It's just like if they had raised rates, like I said, in March of 2021 or so, if they had raised rates 100 basis points, we wouldn't have had the inflation problem. We would have had an inflation problem, but it wouldn't have been what it is now. Now, I think we have a serious chance of a deflationary situation that's occurring. The way when I look at the price of oil, the price of commodities broadly, and layoffs that are coming, which may lead to zero wage growth. So I think the Fed is well behind the curve and should get their act together.
Okay, so I feel like we've set the scene now to then take the next step and figure out what to do from an investment standpoint.
Right.
You talked about gold. Gold's been up a lot. Long-term treasuries have done really well. Those are two of the best performing asset classes in and of itself.
Recently, yeah.
Since the July meeting, correct?
Right, since July, and even since the meeting before that and the meeting before that, long-term treasuries are the best performing asset class, traditional asset classes for the start dates of the last 3 Fed meetings.
Okay.
It's even higher than gold. So it's interesting. So they've done really well. But my thesis is this, that I think gold will continue to do well simply because people don't trust the system anymore. And my prediction was that, and I think I did it future-proof last year, I said we're going to have economic weakness and the initial response will be long-term interest rates will fall because that's Pavlov. You know, you ring the bell, everyone goes, aha, I've seen this movie before. Rates fall when the economy weakens. That's already happened. And I got ridiculed for saying that rates were going to go into the mid-threes. I got ridiculed at that time. Well, guess what? They're in the mid-threes. So I'll call that one accurate. But I don't think they're going to stay much. They might go a little bit lower. I'm still involved in the market. I went to my maximum position in the history of double line earlier this year on long-term treasuries. It was the longest I've been. I actually cut that back a couple of weeks ago by a little, but I'm still near the longest ever side. I'm going to start working that down, because I think what's going to happen is when the recession comes, once there's an awareness that the deficit is going to go to 9% of GDP and we're going to be drowning in long-term treasury bonds, we're going to start seeing people say, wait a minute, where's this interest expense going? And do I really trust what's going on here? And I think they're going to collectively say, no, I don't trust it. And rates are going to do the opposite of what they did for the 40 years pre-pandemic. When we get into negative GDP, I think long-term interest rates are going to start going up. And that's going to be an oh my God type of moment.
So when some suggest that because the Fed is embarking on this cutting cycle, that it's a golden age for fixed income investing, do you not believe that because you don't think rates are going to continue to go down like you just suggested?
I think you have to be extremely careful of your positioning. What I mean by that is, I think long-term treasury bonds will fall in price as we get further along into economic weakness. They won't go up in price, they'll go down in price. Of course, the Fed will cut rates aggressively. So 2-year, 3-year, 5-year treasuries. So we have really one of our best performance years ever going across the firm at Double Line. One of the reasons is we've been committed to the idea that the curve was going to de-invert. And so we're, in essence, this is oversimplifying, but we're basically short the long bond and long 2 to 5-year treasuries, and it's working a lot, and it's going to keep working. So, but it isn't that you're losing money on the long-term treasuries right now, but you're making much more money on a duration-adjusted basis on the short-term ones. And so that's the way we're positioning. I don't call that really a golden age of fixed income. The golden age of fixed income was actually arrived upon when we were here a year ago. I talked about how great everything was because we had rates were up at 5% on treasuries. We had spreads that were very, very attractive, 500 basis points on high-yield bonds and emerging market bonds. I mean, you could get 10% without even trying a year ago in a well-managed fixed income portfolio. Unfortunately, those gains have been realized. So we're now at treasury rates of 3.5%, broadly speaking, and we have spreads on high-yield bonds that are now, well, they were as tight as 280, which was pretty bad. They've widened recently with more concerns growing, but they're at 320. Well, that means that the yield is now 670. So it was at 10, and now it's at 670. So it's clearly not as golden an era for fixed income investing as it was a year ago.
We talked about, I mean, I certainly have on our program recently that the word on the street is that the 60-40 portfolio is back relative to what's been happening with bonds.
Well, certainly it's been back for the past, I'd say, 4 or 5 months. That doesn't mean it's going to stay back. You know, I think the problem with fixed income is if you start out with a yield that's pretty low, you've got a lot of risk and not a lot of income to offset that risk. We've all learned that for sure in 2022, where bonds had double-digit negative returns. The long-term treasury bond had a drawdown of 55%. So you were way worse off in the long bond than you were in stocks, even in 2022. And it's still at a drawdown of over 40%. So I think that we're not in an environment that most of us are familiar with. And it's kind of exciting, actually. I feel that this is sort of like entering the credit crisis. I thought in 2004 that the credit crisis was inevitable because I was at the front lines observing the incredibly lax and imprudent loan origination that was going on in home mortgages. And I said, this is going to be a complete credit crisis. Well, one thing about investing, I'll tell you, from over 40 years of experience, you might be right, whatever, you're right, but it takes longer than you think. Every single time. It takes much longer than you think. And so people are impatient, and they want things to happen immediately, but they don't on an investment level or a macroeconomic level. So I really think that this is sort of like the credit crisis, but this is going to be a fiscal crisis. This is going to be a crisis where we will not be able to afford our debts. And what do you do about that? Well, what do you do when you have defaults on 35% of the homes in America? Well, you do something very radical. You break the law. You modify mortgages. What do you do when GM's about to go bankrupt because they can't afford their interest expense? Well, you break the law, and you take the senior secured creditors and you put them not at the top of the heap in terms of payback. You subordinate them to the pension plan, which is illegal, but they did it anyway. What do you do when corporations are having a very, very bad time looking at what's the shifting sands with the pandemic in March and April of 2020? What do you do when the corporations can't finance themselves anymore? Well, you break the law. You fail to follow your charter at the Federal Reserve from the Federal Reserve Act of 1913, and you buy corporate bonds, which is illegal. So what do we do if we can't pay our unfunded liabilities, which are $218 trillion, which is 700% of GDP? If we wanted to pay them off in today's purchasing power, we'd have to take 10% of our GDP, real GDP, every single year for 3 generations and pay down our liabilities. That's not going to happen. So what do you do? Well, you start out trying something relatively conventional. You start out by saying, okay, we're going to have to finally raise the age on Social Security benefits and other sorts of entitlement programs. We'll have to means test them. That'll be controversial, but I think we'll do it. And then we'll say, okay, so we've reduced the unfunded liabilities a little bit because we just reduced the numbers through legislature. Well, that's not going to work because it's not enough. So what do you do? Well, I've got one of these Byron Wien surprise ideas. I'm not saying that this is a 50% probability, but I think it's more like 30%, and most people think it's not even 10%. Maybe we restructure our treasury debt. Maybe we take all these trillions and trillions of dollars of national debt, $36 trillion, maybe we say, you know what? We're not going to pay a 6% coupon on those old bonds that have a 6% coupon. We're going to make it 1%. And we're going to take every bond that's out there and say, you know what? If your coupon is greater than 1, we're going to make it 1. And if it's below 1, it's going to stay below 1. That would cut our interest expense by 2/3 because our average interest rate is about 3.3. So it would cut it by about 2/3. That would buy us some time. Is that crazy? All these other things I outlined that happened that were illegal and against prospectuses were done. So don't think for a minute that everything's the same. You know, when you're young, at least when I was young, you think the world is never going to change, and it sort of didn't, because I'm born in 1959, and things were really stable economically, class-wise, in the 60s and the 70s. There was economic volatility and problems and wars, but people's lives were relatively constant through that period of time, and you think it's always going to be that way. Well, now that I'm turning 65 this year, I realize, no, nothing ever stays the same. In fact, the rate of change seems to be increasing. So things cannot be predictably stable. They're going to become very unstable. And you can obviously see that in our political culture today, where we actually have, Ian Fleming wrote the James Bond novels, and in Goldfinger, he said something that's very prescient for today's assassination situation. Once is an accident, twice is a coincidence, third is armed enemy activity. So we'll see what happens with that.
When you talk about the rate of change happening so quickly, obviously AI is the topic of every conference you go to everywhere.
AI and private credit.
I'll just let you expand on that because I feel like you want to go somewhere on that.
Well, AI...
I know best when to shut up and just let you talk.
AI is exactly the same today as the dot-coms were in 1999. Terrific long-term potential, tremendous overinvestment and excessive belief that it's all good. There's nothing but good. And then you get the crash, and then the ones that survive end up to be world beaters. I think that will happen in AI as well. I think the overinvestment in AI is just astounding. And beyond that, where are we going to get the electricity? We're shutting down. We have people that want to shut down electricity production, and yet we want this AI stuff that's going to use more than all the electricity we're producing today. How's that supposed to work? Do you know that around 1900, there was tremendous excitement, understandably, about electricity becoming ingrained in society. And there was a huge boom in electricity stocks. And obviously, electricity did change the world. They said it would change the world, and it did change the world. Do you know what, on a relative performance basis, do you know when electricity stocks peaked relative to the rest of the US stock market? 1911. Almost no one had electricity in 1911. So it was all priced in. It had a great future, it changed the world, but it was all priced in by 1911. So this stuff gets priced in. Private credit, I bring that up because at every single speech that I've given, every single appearance, over the past, I would say, 2 years, one of the first questions is, what about private credit? Because everybody's invested in it. You know, when they had those problems at the Ivy League universities, which are probably not resolved yet, but there were donors that were pulling back from Harvard, and they weren't making their donations because they didn't like what was going on. Harvard has something like a $50 or $60 billion endowment, and they came to the bond market because they couldn't pay their bills. They were too locked up in illiquids. They tried to come to market with $2 billion of bonds in order to pay their professors and maintenance and the light bills and all that stuff. And the market actually rejected it. They raised over $1 billion, but not $2 billion. So over $1 billion. My point is, Harvard University was so illiquid in their $50, $60 billion endowment, they couldn't scrape up $1 billion. That's what private credit is. Everybody is locked up in these illiquids. In the credit crisis, I had some distressed funds that were so obviously going to succeed that I could mathematically prove that your IRR could not be less than 20% per annum. And I was going around raising tons of money, and I went to Stanford Endowment came into my office, and I went through my presentation, and he said, I don't dispute a single thing you're saying. I can't invest in this fund because I don't have any money. Stanford. And I said, oh, come on, I really want you on the investor list. You're so prestigious and all that. 10 million, come on, 10 million. And he said, I don't have $10 million. Private credit gets overinvested when public markets look to be overvalued and through traditional analysis. At the end of 2021, I did my webcast, Just Markets, and I went through how overvalued the S&P 500 was versus its own pricing dynamics over multiple decades. PE ratio, CAPE ratio, price to book, price to sales, there's about 25 of them. And most of them were top percentile of overvalued. All of them were top 3 percentile of overvalued. And then I threw out the punchline. I said, as overvalued as the S&P 500 is versus its internal pricing dynamics, it's actually cheap to the 10-year Treasury. Because the 10-year Treasury was at 1%. And the yield on stocks, which you can take the inverse of the PE, the earnings yield on stocks, it was actually much higher than the 10-year Treasury yield. And I said, this is the most amazing thing. We have one of the most overvalued stock markets ever, but it's actually cheap to bonds. So what that means is people that look at these analysis methodologies, they say, I hate stocks because they're overvalued, but bonds are even more overvalued, which means interest rates have to go up, which means the discount rate for stocks is going to be challenging, which means both stocks and bonds look terrible. If I have public stocks, public bonds, I can come to the analysis conclusion, I must come to the analysis conclusion that they're both really overvalued. So what am I going to do with my money? And people say, I know, I got this blind pool for you. I got this SPAC. And they say, okay, so you're going to buy stuff. Okay, I don't know what you're buying. All right, I'll tell you what, I'll put money in your SPAC under one condition. You don't tell me what you're doing. Because if you tell me what you're doing, I'll be able to map stock and bond metrics over to it, and you're going to look overvalued. So just don't tell me what you're doing. So they all throw all this money in. And then when the liquidity dries up, which is going to happen over the course of the next 18 months at the most, you're going to have people that won't be able to meet their capital calls. And so you build up this stuff because of overvaluation, because of bad policy. And so the Fed had bad policy in 2021, and now they have a bad policy, but this time they actually need to ease, not tighten.
So you think private credit, just to put a button on this, private credit's a bubble also?
Without any doubt. I know that when the first question at a large crowd presentation is over and over again talking about private credit, I say, like, well, you're asking me that because you own a ton of it, right? You're an RIA, and you've got your clients all in these funds. And of course now, I think somebody's trying to do a closed-end fund for private credit. You know, it gets weirder and weirder. You know, first someone's so bold as to want $1 billion fund. Then somebody wants to do a $5 billion fund. Now there's somebody doing a $25 billion fund. This is what the top looks like.
So let's finish before we open it for a question or two on the outlook for the election and which candidate would be better for the markets. You have one who talks about raising taxes on the wealthy and on corporations. You have another who talks about increasing tariffs and re-upping the tax cuts. So,
well, they both are running on policies that are suggestive of increasing deficits. You know, Harris throws out these money giveaways. You know, first it was student loan cancellation. Biden did that one. Now it's, you know, $6,000 for this, $25,000 for that. You know, 20% down payment for this. With what money? You know, are you going to take that out of the super fund that isn't funded? Where's that supposed to come from? And then Trump, of course, is talking about tax cuts sort of everywhere. No tax on tips, no tax on Social Security, no tax on overtime. Well, I mean, I don't understand why Social Security is taxed, quite frankly. Why don't you just make the benefit a little bit less and cut out all that paperwork? Why are we bothering with that? You know, I got a letter. I get letters from the IRS now, which, you know, raises your blood pressure a lot. You get home and there's this IRS return address. But I've learned that they have a new policy. I have to make quarterly tax payments, and they now send me a letter saying we've received your tax payment. So I opened the letter, and they said, sure enough, we've received your quarterly tax payment, and they had the amount wrong. I owed, I'm not going to tell you how much, but I owed, let's say, $1. I paid $1, and they sent me a letter saying we've received your payment for $10, except there were 2 commas in the amount that I paid. So they can't even keep track of how much I paid them. And this is what's going on. So we're going to see the deficit go up. I don't think Harris's proposals have any chance of passing for this corporate tax and this capital gains tax. The
unrealized gains, things like that.
That's ridiculous. Unrealized gains. It's ridiculous. You know, what if let's just think. Okay, so I buy a stock, and this is completely implausible, but it's for an example. I buy a stock for 100 and it goes to 200 that day, and it stays at 200 for the entire year. Oh, so I owe, let's say it's a third is the unrealized gains tax. So I owe $33 in unrealized gain tax, and then 1 year from now it goes back down to 100, and I buy it again, and it goes to 200. So I owe another $33, and I do it again. Well, if it ultimately settles in at 100, they'll have confiscated all of my investment in 6 years. All of it, right? So what's going on here? How about the spoons in your kitchen, right? How much are they worth? Do they have an unrealized gain? I mean, how are we going to track this? It's so wildly implausible. But also, we're not going to get these crazy taxes on corporations because the corporations are the donors. Hello? They're the donors. They put the policies up. It's all rhetorical, and it's never going to happen. I do think that Trump would go through, if it's legal, I don't know if it's legal, he would go through with no tax on tips. I think, I mean, that seems easy to cheat, but it's also, it doesn't seem like it's that big of a deal. But these are around the edges going to make the deficit worse. So I just think we're on a deficit-based scheme, and we won't really get true reform until we get off of this system. You know, we have democracy A, which was in place for a long time. Democracy A is the powers that be choose two acceptable candidates. One's called a Democrat, one's called a Republican, and they're pretty okay with whoever wins. So they got that's their hedge. And then we got democracy B, which is, it's true democracy, where you actually elect somebody that isn't acceptable to the powers that be. So you have a candidate A, which is acceptable to the elites, and then you have a candidate B, which is unacceptable to the elites. And it's democracy B that they don't want. It's democracy A that is what they say they're fighting for when they're fighting for democracy. It's not democracy B. And democracy B seems to be awakening. Certainly did in 2016. I don't know if it's going to happen again. I'm very concerned by 2 assassination attempts in 65 days. I'm very concerned about that. And they seem to be awfully, strangely, the security seems very sketchy to me.
Let me finish with one question from the audience that has been previously submitted. It says, Jeff, you said gold is up because of people's distrust for the establishment, but isn't a lot of gold demand coming from central banks? And let me just add to that as you answer that. It plays into an investment idea that you were one of the first that I recall, at least in conversations that I had with investors, to talk about India. Speaking of central banks who buy a lot of gold.
Yeah.
So why don't you answer that question, but also briefly whether you still like India or not?
More than ever. India's got the best demographics in the world. They have the highest, you know, these politicians, like Trump says, we have the strongest economy of all time. Of course that's not true. But the U.S. economy is not the strongest economy in the world. The Indian economy is the strongest economy in the world. Their manufacturing PMI has been the highest of any country in the world for months on end. Their service PMI is the highest for months on end. And now it's actually starting to show up in growth and financial performance. Yes, central banks are buying gold. That's absolutely true. That's part of, but people are too. You know, Costco started selling gold, and they can't get enough of it. The demand is so high, they can't get the supplies in to satisfy the demand. And we're not talking about Rodeo Drive here. We're talking about Costco, all right? So we're not talking about people that are living in 25,000 square foot houses. We're talking about people that are just scared and they don't trust what's going on because they have eyes and ears and they're a lot smarter than the politicians give them credit for.
I saw you raise your hand right here in the front. We got a minute left. Why don't you stand up and yell your question up here? Do you see the deflationary spiral that we're seeing in China happen here?
I don't know about that. I haven't really thought about that. Our economy is so different than the Chinese economy. And it's, you know, it's authoritarian. I've always thought, though, that the Chinese economy was living on borrowed time, because when you have an authoritarian economy, you can turn on and off the credit lever, and you can do it in imprudent ways, and you can do it anytime you want. And I used to tell sort of a facetious joke at presentations. I say, you know, it's weird. Everyone thinks that the Chinese economy has this birthright to grow forever at 6%. Forever. All they have to do is pull the levers the right way, and it's 6% growth forever. And I would say, you know, if that's really true, why are we all so in favor of capitalism? Why don't we install a dictator and have 6% growth forever too? Well, that's because that's not a thing. You can't have 6% growth forever. You can extend it, you can delay the day of reckoning, but it's coming. And the longer you delay it for, the more, you know, the more dynamite you pack into your fake economy, the bigger the explosion when it blows. And that's what's happening because their demographics are terrible. And they're trying to glue it together and they can't. And of course, the negative of that is when dictators have unpleasant economic trends and unpleasant demographic trends, they do something about it, like invade Ukraine, or maybe invade a little island off the coast. And I think that these things are in our future. So will it spill over into our deflation? I think with all the debt that we have, there's a real case for a deflationary recession. And weirdly, interest rates at the long end would rise during that. So it's very exciting. It's like going into the credit crisis. I knew it was going to be a wild ride. It was actually kind of fun because I was largely on the right side of it. I think this is going to be the same type of thing. It's going to be a wild ride, and you free your mind of what you think you know, because they're probably just misconceptions based upon a past paradigm which is no longer in place. So think big.
I think that's a good place to leave it. Let me remind everybody that once again, tomorrow, closing bell on CNBC at 3 o'clock Eastern. Jeffrey's going to join me live right after Jay Powell is finished with his news conference for our
and when they
tradition.
When they cut 25, you can point out that I was wrong.
Thanks so much, Jeffrey, for your
All right,
time today.
okay.
Time goes too fast.